Hi, I'm Christine Benz from Morningstar.com. While many investors consider foreign stocks an essential portfolio ingredient, they may not consider foreign bonds a must-own. I recently sat down with Vanguard's Kevin Jestice to discuss the role of foreign bonds and foreign currencies in investors' portfolios. Kevin, thank you so much for being here.
Thanks for having me.
You are in charge of a team that oversees Vanguard's defined contribution and defined benefit plans. And I'd like to talk specifically about the target date funds, which are such a big presence in the defined contribution space. Let's talk about the decision to add a foreign bond weighting to those target date funds. What kind of research underpinned that decision?
It's a great question. So we've done a lot of research in the last few years around the role of international bonds in a diversified portfolio. And our research concluded that international bonds did offer a diversification benefit when employed inside a portfolio of both stocks and U.S. bonds. But one of the concerns we had was that the currency volatility of international bonds. And so the costs of hedging currency have come down dramatically in recent years. And so we found that a hedged international bond portfolio added diversification benefits to a total stock, total bond portfolio. And in that balanced portfolio construct, international bonds did offer diversification that was kind of a worth the risk return, if you will, addition to the portfolio. So we made the decision to add international bonds, and more recently made the decision to increase the allocation to the international bonds as a percent of fixed income.
Well, I want to talk about that, about setting those allocations. What sort of research did you use to determine? I want to talk about the foreign bond piece as well as the foreign equity piece. What guides the allocations there?
Yeah, so I would say it's both quantitative and qualitative. So the quantitative side, we use what we call the Vanguard capital markets model, which provides projections of expected risks and returns for a variety of asset classes and exposures. We combine that with what I'd call more the qualitative issues, investor behavior, home bias in various countries and regions, et cetera, to inform our decision. At the end of the day, we settle on an allocation, again, to hedged international bonds, but a mixture that is not precisely market cap weighted yet. There's still a degree of home bias for US-based investors in our target date funds. But now we're at 60% US, 40% non-US equity, 70% US, 30% non-US fixed income, and are seeing the diversification benefits, the risk reduction benefits of having those increased exposures to both international equities and international fixed income.
So those ratios stay static throughout the glide path. So if I am 30 or if I'm 60, I get the same ratio of foreign to U.S. bonds and stocks.
That's correct. So the allocation between stocks and bonds changes over time in the target date fund, becoming more conservative in the later years, more fixed income. But the ratio of U.S. to non-U.S. in both equities and fixed income remains static across.
Okay. So a natural question might be, you have hedged the foreign bond exposure, but the foreign stock exposure is fully exposed to foreign currency fluctuations. Why the differential?
Another great question. So in equities are fairly volatile asset class. There's a lot of volatility there as measured by standard deviation. Currency is also fairly volatile. When we look at the additional volatility that currency adds to equity portfolio, so it's both the volatility of currency, the volatility of the equities, and the correlation of the two, we actually only see a very modest increase in total volatility that the currency adds to an equity portfolio, because equities are already so volatile. When we look at bonds, very different picture. Bonds are the ballast in the portfolio. They're the very stable asset class in most portfolios. So when you turn to them for that stability, it turns out that currency is actually very volatile in a bond portfolio because the bonds are so low. So if you have an unhedged international bond portfolio, about 2/3 of the total volatility come from the currency alone. In our view, the role of fixed income in the portfolio was to actually be volatility reducing, minimizing. And so if you hedge the bond exposure, you get back to a far lower volatility total bond exposure. And we think that's appropriate in being a diversified pool of the fixed income versus the equities. So if the costs are the same in stocks and bonds for hedging the currency is what it is, then it's worth the cost to take 2/3 of the volatility out of the fixed income exposure. It's not worth the cost to take a very modest amount of additional volatility out of the stock exposure. And so we leave the equities unhedged and we hedge the fixed income.
Okay. One thing we've seen in the marketplace at large, beyond defined contribution plans and beyond Vanguard, is this strong appetite for hedged foreign products. We've seen a lot of growth in the exchange-traded fund in particular, where investors have been preferring some of the hedged international equity ETFs. What's your take on that trend? Is that something that concerns you?
I'd say my take on it is that when the dollar if investors have a view of the dollar being in or out of favor, you will see investors move from hedged and unhedged, generally speaking. And so our view of whether to hedge between fixed income and equity is not based on a view of the dollar short term.
So it's not tactical?
It is not tactical in any way. It's a very strategic view of asset allocation. And our view is that currencies over a long period of time should be a zero-sum game. And so the hedged versus the unhedged shouldn't necessarily produce a long-term consistent stream of excess returns, one versus the other. There's just cyclicality to the currency exposures. And if that is true, then the cost is a key determinant in whether or not we should do it relative to the volatility. And that gets back to the cost in fixed income is worth the volatility dampening effect. It's not worth it in the equities. But I think you see the cash flows into and out of various products is often based on short-term moves where people have a view toward a strengthening or weakening dollar, and that influences whether they want to hedge or not hedge. That's not a factor in why we hedge fixed income and don't hedge equities, though.
Okay. So the decision to add the foreign bond exposure to the target date products was obviously a big one. Wondering, when you look across asset classes and think about asset classes that might add to those products, might improve those products' risk-reward profile, are there any asset types that are on your radar? Any things that you're looking at for potential addition in the future?
Yeah, we're constantly looking, and we in fact use the term constant debate, not constant change, to talk about our philosophy toward managing our target date funds. We do believe in the long-term profile of a balanced stock bond portfolio, be it exposed to all the sectors, the styles, the capitalizations, et cetera, that they're incredibly well diversified with tens of thousands of underlying stock and bond securities in them. When we look at more asset classes, though, we're constantly debating, should we have exposures to various sub-asset classes, overweights, or asset classes we don't have? But it's that constant debate, not constant change. So in the foreseeable future, the answer is no. I don't see any material changes to the asset classes, but we are constantly debating them. And as part of our due diligence process in managing our target retirement funds, we have a committee that constantly debates the asset allocation, but fortunately is not constantly changing that asset allocation based on kind of the whims or the tides in the market on any given day or month.